Hi everyone, I'm Cam.
And I'm Megan. Today we're going to take what you've learned about how to invest and talk about how to monitor your portfolio's performance.
Can you imagine watching your favorite hockey team play a game without being able to see the score? Or driving a car and not knowing how fast you're going?
These examples would be like investing, but not knowing how your investments are performing.
Investing is not just about choosing assets, but also continually monitoring their performance to ensure they align with your financial goals and risk tolerance.
But Cam, how do you do that?
Well, usually for investments in mutual funds or ETFs, there will be a benchmark to compare performance against. But what is a benchmark?
A benchmark is a standard or point of reference against which the performance of an investment portfolio can be measured.
So, kind of like comparing your grade on a test relative to the class average.
Exactly. Some common benchmarks in the investing world are market indexes such as the TSX, S&P 500, NASDAQ, or Dow Jones Industrial Average.
Now, Megan, why would you use a benchmark?
Great question. A benchmark can help investors gauge whether their investments are performing better or worse than the market. This allows you to measure the effectiveness of investment strategies.
So, the same way comparing your grades with your peers can let you know how you're doing in the classroom.
Yes. What's important is making sure that the benchmark you compare with aligns with the assets in your portfolio.
For example, a tech-heavy portfolio might use the NASDAQ composite as a benchmark, while a balanced portfolio that is half fixed income, half equity may have a benchmark of 50% global aggregate bond and 50% S&P 500.
Finding the right option may sound a bit daunting, but usually if you're investing in a mutual fund or ETF, it will typically already have a benchmark that it's managed to.
But how do you even know what the return is on your portfolio?
Well, let's go through a basic example using apple trees. Let's say you have a farm with 3 apple trees.
Megan, what if the trees increased in value and also grew apples?
In that case, you have even more apples, which in turn would add to your returns. In investing, this is what we call dividends and/or interest. The increase in value of the trees is what we call price appreciation.
Let's dive into the math. Let's say each apple tree is originally worth $100 and increases in value to $133.33. To calculate portfolio return, you would take the current value of your 3 trees, $400, subtract the original value, $300, and add whatever apples have grown, let's say $20 worth, and then divide it by the initial value, $300. Lastly, multiply 100. This would give us a return of 40%.
If that was a bit much, no worries. Most investors would likely be using an online brokerage tool for investing or a financial advisor, where the value of your portfolio is typically outlined for you. No need for those calculators.
Technology takes care of everything these days.
Moving on. While it's important to know how your investment is performing, looking solely at the return of your portfolio is not necessarily the most representative measure of your portfolio's performance. You may also want to look at how consistent performance has been and whether you're taking on more risk than intended.
For example, one apple farmer may yield 1,000 apples each year for 2 years, but another apple farmer may yield 0 apples one year and 2,000 the next. Although they yielded the same number of apples, they did so in very different ways.
This is an example of differences in volatility, or the variation of your investment's returns. To measure volatility, one metric we would usually use is called standard deviation.
Now, standard deviation is the variance of an investment returns relative to its average return. The larger the standard deviation, the wider the returns, and the smaller the standard deviation, the steadier the returns.
Cam, is there a way to measure this volatility in connection to the benchmarks we talked about earlier?
Of course. A commonly used measure is beta, which measures the volatility of a portfolio compared to a benchmark. A beta greater than 1 indicates higher volatility than the benchmark, while a beta of less than 1 indicates lower volatility.
Okay, makes sense. But what if I wanted to have a way to see whether I'm getting enough reward for the risks I'm dealing with?
There are many risk-adjusted return metrics used in the financial world. The most common one is the Sharpe ratio. The Sharpe ratio compares the return of an investment with its risk.
Essentially, it can tell you how much extra return you're getting for each unit of risk you take on.
Think of it like this. Imagine two students, Mindy and Jesse. Each get $10 for doing chores. Mindy had to do easy chores, like taking out the trash, while Jesse had to do something much more difficult, like mowing the lawn on a hot day. In this case, both students earned the same amount of money, but Mindy took on less risk or effort. Jesse may have gotten the short end of the stick there. But in investing, risk-adjusted returns help you see which investment is giving you the best return for the level of risk you're taking.
So, the higher the Sharpe ratio, the better the investment has performed relative to its risk.
Now that you understand how to evaluate the risk-adjusted return of a portfolio to a benchmark, let's move on to an important aspect of maintaining a portfolio that is in line with your risk tolerance: rebalancing.
As you would have learned in a previous Money Gains video, rebalancing is adjusting the weight of the assets in your portfolio to the desired asset allocation.
But why on earth would I need to rebalance my portfolio?
Mainly, you'd want to maintain risk levels to ensure the portfolio has not become too aggressive or too conservative, allowing you to potentially stay on track with your financial goals.
And how do you rebalance your portfolio?
Well, there are 3 easy steps. Step 1. Set a target allocation. Determine the ideal percentage for each asset class in your portfolio. Step 2. Monitor regularly. Check the portfolio periodically to see if the actual allocation has deviated from the target. And step 3. Buy or sell assets to bring the portfolio back to its target allocation.
Monitoring and rebalancing your portfolio will allow you to keep your head in the game long-term as you grow your financial assets.
I hope this was another helpful step in your investing journey. Thanks for watching.